Yeah, superb. Uh, so the topic is the hottest in the market currently, what to do with small cap allocation. A lot of you and cry in media, in our fraternity, everywhere. Uh, this is our perspective on small cap investing currently. Uh, so I'll take you to some historical data points on small caps. So what has happened over last 20 years, pretty much 2 decades, we have seen multiple drawdowns over last 2 decades. We have seen Lehman Brothers crisis, we have seen Euro sovereign crisis, taper tantrum, ILFS crisis, COVID, global rate hike cycle, and the recent one is a tariff war. We have seen through all the 6 crises, and if you look at small caps, they have only emerged stronger out of every crisis. This is what history and data shows. So what were the major drawdowns which we saw in all the last 6-7 crises which we saw? Subprime crisis, we saw 73% drawdown in the markets from the peak. Euro crisis, 29%. COVID was 43%. Current crisis is 22%. So these are the broad range. Anywhere between 22% to 70% have been the drawdown in each of the crises we have seen in the past. But more important part is the period in which this bear market lasts. So what's happening in last 2 decades, bear markets are getting shorter and shorter while bull markets are getting longer and longer. So the maximum period which we saw of a drawdown was in Lehman crisis, which was 11 months. But on an average, if you can look at data, 5 to 7 months is the period where we have seen the bear market or the drawdown in small caps which have lasted for. So where are we currently? We are almost on the 5th month. So is this the bottom? I don't know. But are we closer to the bottom? I may say yes. Based on the data, based on history. Maybe a month of volatility, possible. Can it correct more 4-5%? Can. But we are at the last fag or the last leg of the correction we are seeing. And what gives me confidence is in the past 6-7 instances which you can see on screen are all crisis year. You saw Lehman crisis, you saw Euro sovereign bond crisis, taper tantrum, ILFS crisis. This time there is no crisis. This is not a crisis year. Just be mindful of that, and when you communicate to your end clients also, there is no crisis happening in global markets or in India. This is what excess valuation or the froth in valuation is getting self-corrected, which I believe is very healthy for the markets. If we are in play for a longer bull market, corrections like this are very important for a sustainable bull market. So it's very important to communicate to the client that this is not a crisis year, unlike in the past. So what has happened after every crisis? Small caps have emerged much stronger. So post Lehman Brothers crisis or subprime mortgage crisis, market have bounced back 215% from bottom. Post COVID 249%, post taper tantrum 304%. The magnitude of the bounce back after every fall has been much sharper and much longer. See the duration, 24 months post COVID was the bull market. Post taper tantrum 54 months. Post COVID almost 22 months. So the bull markets are getting longer, the bear markets are getting shorter, and small caps are emerging even stronger after every crisis. Now this is a very interesting slide. This showcases data for small cap 250 index as back as we can go to, which is 2006. If you look, after every red year or a negative year, most of the years we have seen a positive return year. So after COVID crisis, the next year we saw 114% return in 2009. Post taper tantrum, we saw 70% move. Post COVID, we saw another 62% move. So where are we? We are 18% down from the top in calendar year 25. But over a longer term period, 20 years, average returns which small cap index gives is close to 21% vis-a-vis large caps, which give 14%. So generally small caps have a tendency to bounce back after every negative year. So I think this year, which is negative, one should take it as an opportunity rather than fearing it. And that's the message I would like to convey to you, which can which can be conveyed to your end clients as well. That rather than fearing, you are getting more units at a lower price, more SIPs at a lower price in terms of valuations or in terms of your value in that. And for us as a fund managers, we are getting good valuation to buy into good companies. So we were waiting for the period such happen, and now what's happening on street, everyone is panicking actually. But generally it should be the converse. One should be bold when there is a crisis, and the vice versa. When there is euphoria, one should dial down. This is how history has played out in equity markets over longer term time period. So what has small cap done over last 20 years? They have made investor return grow 15x. It's not a small amount. A crore invested in 2005 has grown up to 15 crores in 20-year time frame, while large caps have grown 11x. That's 11 crores. So in CAGR terms, because point to point it's very difficult to guess estimate the numbers, but you will see CAGR 1-2% differential, but the magnitude of number of times the multiplier effect happens in small cap compounding is much higher. 4 crores higher money small cap index might have returned. This is, I'm all talking of index. Generally, active funds have outperformed index materially over this time frame. So the key word is, so when to enter. People say, kab bazaar mein aaya, when to enter. So it's more important is time spent in the market is much more important than timing the market. It doesn't matter I start an SIP today, tomorrow, a year back, 5 years back. If I have the holding period of 5, 10, 15, 20 years, it just doesn't matter when you enter it. That's the whole process. You should spend as much time in the market is the crux rather than timing. Should we buy at this price or market will go down 5% or 10%? It doesn't matter in the longer time frame. Valuation, the talk of the town is small caps are at obnoxious valuation, they are very richly valued, XYZ. This is a data which we have pulled out from Bloomberg. So this is not our source, it's a Bloomberg source. Small caps are trading at a premium to large caps? Undeniably yes, 22 times versus large cap index at 19 times. They are not trading at 40, 50 times as people on street are saying. This is hard data. 1 year forward, there is a premium of 15% for small caps and maybe much higher for mid caps. But nowhere closer to obnoxious 35, 40, 50 times based on the data we have on the small from Bloomberg. But just looking at small cap valuation at 22 times and Nifty valuation at 19 times would hardly make any sense. You should have more meat to the table. What we tried doing is add earnings growth momentum, which is the cursory thing or the main thing to look at small caps. There you will see the earnings growth for a Nifty will be 11 to 12% over next 2-3 years, but for small cap index is expected to be 18%, which is almost 6 percentage points higher than the large caps. Just to give you an example, what is the benchmark of small cap 250 comprises and what is the benchmark of Nifty 50 comprises? That is very important for you to understand so that you can communicate to your end clients. People just blindly compare Nifty 50 small cap and they say it's premium at 20%, but there is a reason to it. Nifty 50 or large caps comprises more and more of mature companies, HDFC banks of the world, Infosys, Hindustan Unilever. Now, if you look at their earnings growth momentum, they can hardly grow more than 5-10%. HDFC Bank cannot grow at 20%, gone are the days. They can at best grow at 10-12%. Same with Infosys, Lever will be, if they grow in mid-single digit, also will be a big hallmark for them. So, they are the bigger elephants they have become. So, their earnings growth cannot grow more than 10-12%. And 1/3 of the index is financials, banks, predominantly in Nifty or large cap index, while FMCG and IT comprise another 15-20%. So 50-60% of the index constituents can't grow more than 8-10% on a sustainable basis. So whether looking at small cap index and Nifty index makes sense, I think completely wrong. Now I will highlight what is small cap 250 index comprises of. So there is only a weight of 18 to 19% of financials in small cap index, vis-a-vis 33-34% in the Nifty. And what comprises in small cap index is more of capital markets, which is your exchanges like BSE, your asset management companies like Nippon, Aditya Birla, UTI, or for that matter RTA players like CAMS, KFIN, or CDSL types of businesses. Now if you look at where we are in terms of penetration, etc., they have a very long runway of growth. Prudent also included in this. They can compound earnings north of 15-18% over sustainably 5 to 7 years. So your banks can grow at 8, 10, 12% at max. These companies can grow at maybe 17, 18%. There is a differential. So do small cap need to be at premium or discount? I leave it to you. Because earnings growth will be much superior always in a small cap, considering we are not in a crisis situation. We are in a situation where our economy is still growing at 7.5%. Government is stable, policies are supportive, budget was very conducive for consumers. So we are not in a year of crisis where the economic growth is going to slow down. Whenever economy doesn't do well in those phases like post ILFS crisis, 2 years the economy was sluggish. That is a period when earnings growth of small caps will be slower. But in the years where economy is fine, global macro setup is fine, and government is stable, small caps sensitivity to earnings is much superior. So capital goods, which is another big subsector of the benchmark in small cap 250, is almost 15-16%. So your likes of all those capital good companies or EMS plays, electronic manufacturing, will feature here. None of them will feature in large cap index. Without naming any company, but electronic manufacturing as a sector is growing at 30-35% over next 3-5 years. Semiconductor, everything will come here. So I think the durability of earnings growth and the longevity and sustainability will be much superior in small cap, and that's where we look at valuation adjusted for earnings growth. This is called PEG ratio, which we adopt in our investment framework as well. We just don't look, say X stock is at 40 times, but is it growing at 50% for next 3 years? Then that 40 times is justified. 10 times the stock is cheap in layman's language, but if it's growing at 5%, it deserves to trade at 10-12 times. So valuation adjusted for earnings growth, small cap index is at 1.22 vis-a-vis Nifty at 1.76. So this is a very sharp and very strong barometer, PEG, while valuing small caps, and just comparing with market caps and premium to large caps is giving a half picture to the whole story. That's what we believe. Now if you want to play unique themes, you have to be in small and mid caps. So if I want to play electronic manufacturing services business, there are only small and mid cap companies. There are no large cap companies to play. If one has to play capital markets, as I mentioned, all these RTAs, exchanges, depositories, they are only in small and mid caps. Same way specialty chemicals, auto components, healthcare services includes diagnostic chain, hospitals, hotels, QSR. So all these sectors, I would club it into, or CDMO for that matter, I didn't mention, but CDMO also. What I would say, all of them are sunrise sector, emerging sector. So one has to focus on which can be the next multi-baggers, which can be the sectors which can really balloon investor wealth. So the multi-baggers will come from there only. From here only, small caps will become mid caps and small caps will become large caps. Large caps cannot grow from there where they already reached. So these are the themes one has to play. They are only present in small cap and mid cap. So another myth which investors have, whether small caps means low quality. Small caps है तो maybe quality का issue होगा, कचरा तो नहीं, XYZ. But it's a myth. The largest AC component player or a AC player is in small and mid cap. Largest RTA player, which is say CAMS or a KFIN, is into small caps. Largest depository, largest diagnostic chain, largest children hospital or mutual fund distributor, auto bearing company, name it. So it's just the segments are smaller. Companies quality wise are the leaders in what they are doing. There are many MNCs into this. It's just that the segments are smaller, but they have opportunity to become really big over next 5 to 10 years. You are from capital markets play, you can understand what I'm relating to. Where we were 10 years back, no one would have thought the SIP numbers would be 26,000 or close to $3 billion a month. This can go to $5-6 billion. I am very positive this can happen. So the thing is, you have to completely focus on which will be the sunrise themes, which will be the emerging sectors, and most of them will bucket in small caps and mid caps. Now these are two small examples I have put in of the share price movement of a leading fashion retail company without naming it, and a leading jewelry retail company, which everyone may know it, but I have just not mentioned the name. If you look at 20-year period, they have gone multiple X's. From being a small cap, they have become large caps. If you just look at the share price performance. Important is what happened in last 20 years. Almost 7 to 8 years, each of this stock has seen 30, 40, 50% sort of a drawdown from their highs in that period. So small cap by nature are volatile. So rather than just fearing small cap hai 25% ऊपर गया नीचे गया, no, you have to just think long term. Think from 5 years. You are not buying a share to sell it tomorrow. When you buy an insurance policy, you do not go to your agent or something that I want to redeem it next year. You play it for 10 years, 20 years. So this as a product has to be taken for a long-term point of view, and volatility should be treated as a friend and embrace it rather than fearing, because volatility will give you that opportunity also, where people will panic, you will get the prices of very good companies, which is happening currently, which we are also looking at. So the best of the companies also see very big drawdowns, but still they have emerged from a small cap to a large cap over 15-20 year period by a margin. Now what is the philosophy at Union? So I have recently joined Union 2 months back. I was earlier with UTI. The philosophy for me, or before that I was with Edelweiss Asset Management, philosophy from my early days has been very clear. We won't go down the quality curve despite we going down the market cap curve. So we may invest in mid and small cap, but the quality of companies we invest will be right at the top of our focus list. So we'll be investing in very high quality businesses which have characteristics of high earnings growth and better return ratios over medium to long term time frame. Invest in companies either they are market leaders or gaining market share, or in a duopoly, monopoly sort of a business where they have the right to win. The biggest focus in investing in small cap and mid cap for you also to understand or to convey to your end clients is the management quality. Corporate governance, it should be the right at the top. Which are the names your fund you have suggested? Just check the list on the fact sheet. What are the names? Are there of names which are very shady, run by shady management, not good corporate governance? Because they can fall in a pitfall, and the falls are not 5-10%. In large caps, maximum you will see at 10%, 15% fall. Small caps can go to zero. This is a harsh reality. So you have to be with those management promoters. We are very high on integrity. They have shown good execution skill set, and corporate governance standards are very high. This is where we focus completely on while investing in small caps. We also invest in companies which have larger target addressable market. TAM is what? Target addressable market, where the opportunity size is really big. Say for example, capital market. Next 10 years, this will be the decade for capital markets, I believe. So you invest in businesses which are a play to participate in the large market opportunity. So you have to be investing in companies which are part of the ocean or a sea, not part of a pond. Because if good companies are there but the opportunity size is smaller, then they cannot grow earnings by 20%. So that's another part. And we completely focus on sunrise sectors where potential high growth rates are there in their earnings. So the whole thought process is to identify early the emerging sector or the next sunrise sectors and invest in a meaningful way on that side. So importantly, what to do with small caps? So I would say embrace volatility rather than fearing it. Have a reasonable return expectation. What we have seen in the past around COVID and all, 50%, 70%, 100% sort of returns we have seen in annual, like in a year's time. But have a moderate return expectation for your clients, 15, 17% over CAGR over next 3, 5, 10 years. That would be ideal while investing in small cap, so that the expectations are set for the investor also, rather than he thinks a small cap is a what is a magic box where money doubles. Set him a reasonable expectation. That's my simple point, so that he will have a good experience in investing rather than shocks. That this is only given 18%, I was expecting 50%. This is a 15 to 18% product. Ideally, in good times it can give 50%. That's a bonanza. Continue your SIPs. So the big message I want to put it is, continue your SIPs. This is the time to put SIPs. If you don't put SIPs, when index is down 22%, individual stocks are down 40-50%, good quality business, then when would you put SIP? When would you add? When the markets are again back highs. This is the time will you get more units at a lower prices. So I would suggest this is the best time to add SIPs. If market stabilizes, increase SIPs, and there will be a time to get into lump sum. Maybe next few months will tell us, but this is the right time to at least keep adding on the SIPs and increasing the SIP portion in small cap and mid caps on every fall which we see from this level. And focus on your strategic allocation, asset allocation for your clients, which may be some who has underly positioned in small and mid caps can be increased, and some are obnoxiously high can be moderated. So asset allocation is based on the investor profile. That is focus area for you guys more than me, but that should be at the paramount. But the message here I want from this forum is, please continue your SIPs, increase SIPs on every fall. That's the bottom line. And I will be more than happy to answer you if you have any questions. Sorry? Yes. Sure. So, as I told, I was with UTI. I have joined just 2 months back. Give me some time. I have reconstructed the portfolio over last 2 months despite the market fall. And now if you look at the texture and composition of the portfolio, you will get a color how I have resized or restructured the portfolio. So the limited point is, as and when market stabilizes and starts looking better, we should come back. And to tell about me, I just recently joined, so at least I can get that benefit of doubt. So quantitative easing was there, right, in the US. Quantitative easing. So if you remember, post Lehman there was money printing happening, quantitative easing was there. That stopped and quantitative tightening etc. happened in 13-14, where you saw dollar really spiking. Just if you remember election speeches of Mr. Modi, he was mentioning dollar, रुपया लुढ़क गया 50 हो गया कुछ और 70 हो गया, I don't know the number. That was a time when money flew to US basically. Rates started going up. From easy cycle, it started tightening. So people flocked towards US dollar, US treasury. Yeah, this is the time, no? This is ideal time. We have not come for... No. We have not come with an NFO, sorry. No, I don't have it on my slide. Sorry. I will share it with you. No. This is not NFO. Sure. Strategic asset allocation in the... Yeah. Yes. So small caps by nature are volatile product. Okay. So they need a completely different sort of investment appetite. So it may not be ideal for everyone. If I go, so I'll give you an example. I went to a bank few years back without naming that bank. The relationship manager was pushing a small cap fund to a person who was aged 80 years, who had a FD. Okay. Is it a product suitable for him? I would say no. I blasted at that RM. I said, is it a product which is suitable for this gentleman at this age? No. So you are the best judge of your customer's profile and how much allocation is required. A young income earning investor can have slightly higher small and mid cap. As age progresses, the allocation should be moderate, but there should be there to give that alpha as a barbell approach. It's not, it's, no. You are partially right, but even large cap index keep changing. So I will give you an example like Trend, which was a small cap few years back, was a mid cap couple of years back, became a Nifty 50 stock. I have n number of examples because we invest. So it's not that Nifty 50 stocks complexion doesn't change. 10-20% of changes happen even in Nifty 50 stocks. Similar changes happen in small and mid cap indices. It's not that 50% changes happen in small and mid caps and here 0% happens. 10 to 20%, maybe 5% plus minus happen. But even at Nifty 50 level, Shriram Finance, I have multiple names, example. They come in Nifty 50, they are mid caps or maybe small caps few years back. That's my limited point. Great. Thanks a lot. Thank you.